the recent decision by the Federal Reserve to reduce interest rates to their lowest point in 3 years. A significant change. What occurred? On October 29, 2025, the Federal Reserve decreased its benchmark federal funds rate by 25 basis points, 0.25%, adjusting the target range to 3.75% to 4%. This marks the lowest rate since late 2022. Concurrently, the Fed declared it would cease its strategy of reducing its balance sheet, known as quantitative tightening, effective December 1. Reasons behind the Fed's rate cut: deteriorating labor market and growth apprehensions. The labor market is exhibiting signs of cooling. Job growth has decelerated, unemployment has slightly increased, and the Fed is becoming more apprehensive about potential downside risks to employment. Economic activity growth is slowing, and with inflation still above the target, albeit decreasing, the Fed perceives greater risk in maintaining high rates than in implementing cuts. Inflation remains high, yet is easing. Inflation continues to exceed the Fed's long-term target of approximately 2%. Although inflation has been declining, the economic and labor market slowdown have intensified the dilemma. Delay the cut and growth may falter. Cut too soon and inflation could rebound. Liquidity and market functionality. The Fed pointed to pressures in short-term money markets and bank funding costs as additional justification for easing. By terminating quantitative tightening, the Fed is indicating its desire to ensure that liquidity remains adequate, not solely by lowering the policy rate, but also by stabilizing its balance sheet. Immediate effects and market responses. Borrowing expenses. The rate reduction decreases the fundamental borrowing costs for banks, which may subsequently lead to lower interest rates for mortgages, business loans, and credit cards, although the transmission is generally gradual. Some analysts anticipate further declines in mortgage rates as a response, but they caution that these rates are influenced by numerous factors, including credit spreads, investor demand, and long-term bond yields.